Welcome back to International Financial Management. So far, we have spent a great deal of time understanding the foreign exchange market, how exchange rates are quoted, how they move, and what factors influence exchange rate. Today, we move into a very important and practical topic, which is called foreign exchange exposure and its management. Whenever a company deals in foreign currency, it faces the risk that exchange rates may change before the transaction is completed. These changes can affect the company's cost, revenues, profit, and cash flows. There are three major types of exchange rate exposure, which we have also discussed before. They are transaction exposure, translation exposure, and operating exposure. Today, we will begin with the first and the most direct type, which is called transaction exposure. Transaction exposure refers to the risk that the value of an already committed foreign currency transactions may change because of exchange rate movements between the date the contract is entered and the date the cash is actually received or paid. There, there are three very important words in this definition. First, it is specific, second, contractual, and it is a known amount. This means the transaction is not hypothetical or uncertain. The company has already made a commitment. For example, suppose an Indian importer agrees today to pay USD 50,000 after 90 days. The amount and the payment date are already known. However, the exchange rate may change during these 90 days. If the dollar becomes more expensive, the importer will have to pay more in rupees. So, the period between the contract date and the settlement date is also called the exposure period or the risk window. A very simple rule applies here. The longer the exposure period, the greater the risk. A 90-day exposure is usually riskier than a 10-day exposure because exchange rates have more time to fluctuate. Let's think about who all faces this risk in real world. Many different types of firm face transaction exposure. First, importers buy goods from foreign suppliers and usually have to make payment in foreign currency. If the foreign currency appreciates before the payment is made, the importer suffers. Second, exporter sells goods abroad and receive payments in foreign currency. If the foreign currency weakens before the payment is received, the exporter suffers. Third, borrowers of foreign currency loan may borrow in dollars, euro, or some other foreign currency. If that foreign currency appreciates before the loan repayment date, the company repayment burden increases. Fourth are the companies paying dividends, royalties, or technical fees abroad. A multinational company may have to remit dividends, royalties, franchise fees, or technical service fees to its parent company or other overseas entities. These future payments in foreign currency also create transaction exposure. So, the common feature in all these transactions and all these situations is one, and that is there is a future currency cash flow that has already been committed. Now, let us understand the transaction exposure with help of an example. Let's take the example of the exporter. We have been given Britannia Textiles Limited, which is a UK based exporter, and he has sold goods worth $10,000 to the US buyer. Payment is receivable in 3 months. We have been given spot rate of today, that is the current spot rate, and we have been asked the following question. What is the expected British pound inflow at the time of the contract? Because exporter will definitely going to change the dollar receipt into the British pound. If the second question given to us, if after 3 months the British pound appreciates to 1 British pound is equal to $1.42, what is the actual payment? And the third, if after 3 months the British pound depreciates to 1 British pound equal to 1.28, what is the actual payment? Now let us do this question. Now the spot rate given to us is 1 British pound by USD is equal to 1.3567. And if we have to convert it today, then what is going to be the British pound? Now exporter will receive dollar payment, dollar revenue, and he will convert it into British pound. Why? Because the exporter is UK based. So how he will do it? We have been given the GBP value. Now the expected GBP inflow at this rate will be equal to 1 USD. Let's first convert it into British pound is equal to 1 upon 3567, which gives us a rate of 0.7371 British pound. Now this we will multiply with the value, and the value of the transaction is 10,000. $10,000 into 0.7371 will give us pounds 7,371. Now after 3 months, let's say the British pound appreciates, and now the value of 1 British pound is equal to $1.42. British pound has become expensive. Now what we are going to do is we will first take the value of 1 USD, which will be equal to 1 upon 1.4042. This gives us 0.7042. Now we will multiply it with the amount that he is going to receive in dollars, which has been given to us as $10,000 into 0.7042. This gives us pounds 7,042. Now what happens when the British pound depreciates? That means here the value of 1 USD will be equal to 1 upon 1.28 GBP, which gives us how much? It gives us 0.7812. Now here if we multiply it with $10,000, then it is going to be 7,812 pounds. Now we have seen that if the contract is made at the today's spot rate, he is going to earn 7,371. But if the rate changes and the British pound appreciates, then the exporter incurs a loss. Here the domestic currency has appreciated. But if the domestic currency depreciate, because the exporter is UK based, so GBP is his domestic currency. If it depreciates, then he gains through it. Or we can also say that if the foreign currency appreciates, exporter gains, and if it depreciates, exporter loses. Now let us understand another question with help of an example, in which we have been given Sakura Electronics Company, which is a Japanese importer, and he has purchased industrial components from a US supplier worth $5,000 payable in 3 months. We have been given the spot rate, Japanese in USD, Japanese yen quotation. Now we have been asked that how many Japanese yen will the importer pay today, and what is going to be the scenario when the USD appreciates. That means USD per Japanese yen become equal to yen 167. we have to calculate Japanese yen payable after 3 months, and the case 2 given to us, if it USD depreciates, that means Japanese yen strengthens, then what is going to be the Japanese yen payable after 3 months. Now here things are simple. We have an importer, and this importer is in Japan. Now this importer will first buy USD, and then is going to pay. Now pay to the exporter. Now what is he going to exchange when he will buy USD? He will exchange yen, that is the Japanese yen, right? Now here, if suppose he buys it, if he buys it at this current rate, which is the today's rate, then how much is the payable in the yen? Now here yen is the domestic currency and he has to pay the foreign currency, which is in dollar. So into the yen rate which has been given to us, this becomes yen equal to 7,94,250. Now let's say the USD appreciates. Now it becomes more expensive to buy USD, and hence it is adding on to the payable of the importer. Now if he has to first buy the USD, and here the cost of 1 USD becomes 167, and hence the total money that he has to pay in terms of his own currency, that is domestic currency, is yen 8,35,000. Now let's go to another question in which the USD per Japanese yen is 150. That means it has depreciated from the current spot rate account and is now 150 here. So here 5,000 into yen 150 becomes 7,50,000. Now here if we see that in this case the dollar has become cheaper. Now he can buy 1 USD with 150 yen, and that is why the total payable has become very less as compared to the today's rate. While if you compare it when it appreciates, when the USD depreciates. Another question that is given to us is about the loan repayment. There is an Indian company which has raised a loan of USD 5,000 from a bank in USA. The company has to repay the loan in monthly installments of USD 1,000 each. At the time of taking the loan, the exchange rate was expected to remain at rupees 80 per USD. However, the value of the dollar keeps appreciating against the rupee over the next 6 months, and we have been given the actual USD INR exchange rate for the coming 6 months. Here we have to calculate the expected rupee liability per installment and total over 6 months, the actual rupee liability for each monthly installment, and the increase in cost due to dollar appreciation. Now let's see that if the dollar had remained $1 had remained 80 rupees throughout the loan repayment period, what would have been the expected monthly liability? Now here we are giving $1,000 every month as an EMI, and 80 rupees is the conversion cost of dollar to rupees. So 80,000 rupees was the payment that we had to make every month if the dollar remained at 80, and the total expected payment would have been rupees 80,000, giving us 4,80,000 rupees. Now you can see from the table that the USD rate is increasing. USD is becoming expensive day by day vis-a-vis the rupee. It is appreciating, and hence our rupee liability will also change. Though our EMI in USD is going to remain same, that is going to be 1000 every month. There is no change in our EMI. But if we say that in EMI in rupees term, what is going to be the change? So we will just multiply these and we will find out what is our rupee liability per month. We have been given that the dollar is appreciating. So you can see that the value of dollar is appreciating every time. So it is 82,000, 85,000, 87, 89, 90 and 92,000, so on. Now we will add all these and we get 5 lakh 25,000 here. Now if we see what is the extra cost that we have to pay because of the increase in the USD price, or we can say the USD has appreciated. So the extra cost is 5,25,000 that we have paid over the loan period minus what we were expecting before, which is 4,80,000. This gives us 45,000 rupees is the extra cost that we have paid. Our EMI in USD have not changed. We have incurred this extra cost only because our exchange rate has changed and USD has appreciated. Let me now highlight the defining characteristics that make transaction exposure unique among the three types of exposure. The transaction exposure has certain characteristics that make it different from other types of foreign exchange exposure. And the first is it is short term and contractual. It arises from specific commitments already made. Second, it directly affects cash flows and the profit. This is not just an accounting adjustment. If exchange rates move unfavorably, the company may actually lose money. For example, if company suffers an additional cost of 8 lakh because of exchange rate changes, that loss will directly affect its profit and loss account. Third, it is precisely measurable. Because the amount and the date are known, you can calculate your exposure to the last rupee. That makes it very manageable from a risk perspective. Fourth, and this is a very important thing, it is easy to manage. It can be hedged very easily because you know exactly what amount you are exposed to and for how long. You can use the financial instruments with precision to eliminate or reduce the risk. Fifth, it is time bound. Once the cash settles, the exposure is gone. This makes it distinct from operating exposure, which can persist over years. Now that we understand what transaction exposure is and where it comes from, let's talk about how to measure it, because you cannot manage what you cannot measure. The process has 5 steps. Step 1, you identify all exposed positions. The firm must prepare a list of every foreign currency receivable, like export proceeds and overseas dividends, and also every foreign currency payable, like import bills and loan repayments, payment to royalties, etc., along with their exact amounts and due dates. In simple words, the company prepares a future foreign currency cash flow statement. The next step is that we have to calculate the net open position. The basic formula is net exposure is equal to total foreign currency receivables minus total foreign currency payables. Step 3 is to convert everything into a common currency. Usually, firms convert all future foreign currency amounts into domestic currency using the current spot exchange rate. This helps the firm understand the total size of its exposure in rupee terms. The fourth is you have to estimate the potential gain or losses. Once the net exposure is known, the company estimates how much it could gain or lose if the exchange rate changes. The formula is Potential loss or gain is equal to net open position into expected change in the exchange rate. For example, suppose a company expects to receive USD 10 lakh after 3 months. If the dollar weakens by rupees 2 during the period, the company will receive 20 lakh less than expected. The calculation is 10 lakh dollars into rupee 2, which is equal to 20 lakh loss. This helps management understand the rupee impact of the exchange rate movements. Step 5. Decide the hedging strategy. After measuring the exposure, the firm has to decide whether to hedge or not. The decision depends on the size of the exposure, the expected movement in the exchange rates, the company's risk appetite, the cost of hedging. The firm may decide to hedge the entire exposure or only a part of it or leave it unhedged. Now, measuring transaction exposure. If receivables are greater than payables, the firm expects to receive more foreign currency than it has to pay. Therefore, it has a net asset position in that currency and is called long in foreign currency. If payables are greater than receivables, the firm has to pay more foreign currency than it will receive. Therefore, it has a net liability position in that currency and is called short in foreign currency. Now, for example, receivable is equal to USD 1,20,000 and payables is equal to USD 80,000. So, net exposure is receivables minus payables, which gives us plus USD 40,000. The firm is long in USD because it will finally receive USD 40,000 more than it pays. That is why exporters are generally long in foreign currency because they mostly receive foreign currency. Now let us estimate net transaction exposure with help of an example. We have been given the following data. We have been told that there is an Indian textile exporter and who has entered into export contracts, and the following foreign currency exposure as on March 2021 2010 is given. We have to calculate the net transaction exposure for each currency and comment on the firm's position. Now here, this first step is going to be that we have to classify all receivables and payables according to the currency and the maturity period. This is important because only items in the same currency and with similar maturity can be netted or offset against each other. Now here we have been given two currencies, one is USD and the other is Euro. We have been given payables and receivables of the both. We have also been given two maturity dates, which is 45 days and 55 days. Now, how do we find out? First of all, we will classify. And how do we classify? Let us classify USD dollar exposure. And this has to be done for, we have to also see the number of days. Here the dollar exposure mostly are in 45 days due date. So we have 45 days here. So we will first see how much receivables we are getting. The receivables we are getting is in the form of US dollar interest receivable, which is US dollar 11,000, this one. We also have a US export receivable. So we have US dollar export receivable, which is equal to how much? It is 87,000 US dollar. It is 87,500. So the total receivables that we will get is how much? It is US dollar 98,500. Now let us talk about the payables. Now we will have to understand where do we have the payables. We are paying interest in USD. We are also paying in import. So we have an import payable as well as the interest payable. So let me write here as import payable. And we will see that in all the cases, whether it is import payable, it is 45 days here, or interest receivable 45 days, or payable, interest payable 45 days. So we have to also check the number of days here, and it should be same. So here import payable is US dollar 90,000 and interest payable is US dollar 9,000. So the total is 99,000. So what is this? Is the payable, and this is the receivable total, and this is the payable. So what is our net exposure? Net exposure is going to be 98,500 minus 99,000. So this means it is minus US dollar 500. So we are in short, and this is our liability here. Now had it been 55 days, let's say if it had been 55 days, then it would not have come in this particular calculation. It would have been considered separately. Now we will also find out the euro exposure. So let us find out the euro exposure. What is the euro exposure? Here the euro exposure, we will see what are the various receivables. We have euro export receivables, then we again have another euro export receivables. Both have to be received in 55 days. We have to make a euro loan payment, and it is in installments, and it is here also the maturity date is 55 days. So what we are going to do is euro, we will calculate the receivables where we have two export receivables, and one is this one and the other is this. So we have 25,000 given to us here, and we have plus 70,000. So this gives us around 95,000. And what is going to be the total euro payables? This was euro payables. The euro payables given to us is only 80,000 euro. So what is the net exposure? Net exposure in euro, which is equal to receivables minus the payables, and here we get 95,000 minus 80,000. So here our position is plus more. So here we have plus 15,000 euro. It is a net asset situation, and it is we are in long in euro. So if we see that we have two kinds of exposure right now, one is USD exposure and the other is euro exposure. Here the exposure is plus 15,000, we are long in euro, and here it is minus 500, we are short in USD. After knowing this, we are going to find out what should be the hedging transaction or hedging strategy for these two exposures. So we will separately hedge them. So what to hedge? The firm has a net payable position of 500 USD in 45 days, and the firm has a net receivable position of 1500 USD in 55 days. This example highlights an important point. A firm may simultaneously be short in one currency and long in another currency. That is why exposure should always be measured separately for each currency and maturity bucket. Only after this analysis can the firm decide the appropriate hedging strategy for each currency. Now we move to the methods used to manage or hedge transaction exposure. There are five primary hedging instruments used in practice. We have forward contracts, futures, money market hedge, currency option hedge, and currency swaps. Among these, forward contracts are the most commonly used because they are simple, flexible, and directly linked to the amount and timing of the exposure. In the next part of the week, we will discuss each of these hedging methods in details and understand how firms use them in real business situations. That's all for now. Thank you. See you in the next lecture.